Well, with the U.S. midterm elections behind us and the economy the #1 issue on voters' minds, what will lawmakers do now to respond? Well, one proposal floated by politicians of both parties is to raise taxes on multinational corporations as a way to discourage them from shipping jobs overseas. Our next guest says that logic is flawed and could ultimately hurt the jobs market right here in the U.S. Joining us now is Daniel Griswold from the Cato Institute. It's a conservative think tank. He's the director of the Center for Trade Policy Studies there and has recently written a book titled Mad About Trade: Why Main Street America Should Embrace Globalization. Dan, thanks so much for joining us today.
Glad to be with you.
All right, this is a complicated topic, and I know you're going to be able to simplify it first, but I thought maybe if you could start a little bit with the current U.S. corporate tax code and how it could actually change.
Yeah, during the campaign, President Obama tried to make a lot of hay about these tax breaks for U.S. companies that ship jobs overseas. It's really a bogus issue. You know, the United States has one of the highest corporate tax rates in the world, near 40%. The rest of the world is down in the 20s or lower. And the whole idea, it's called deferred earnings. When U.S. companies, multinational companies, earn profits on their activities abroad and their affiliates, they don't pay the U.S. corporate tax until they repatriate that money to the United States. And there's a perfectly good reason for that. They're out there competing in foreign markets with Japanese and German and Korean companies who are all paying the lower rate imposed on corporate income in the country where they're competing. If we force them to pay the higher U.S. rate, we're going to put them at a disadvantage and force them to cede important markets. And, you know, increasingly investing abroad and producing and selling things from foreign-owned affiliates is how U.S. companies reach their foreign customers with U.S. branded goods and services. They sold about $6 trillion a year from their affiliates. That's 3 times as much as they export from the United States. So this is a big issue.
So, Dan, we were talking a little bit about U.S. manufacturing companies investing tens of billions of dollars in these foreign countries. It is, though, logical to take the other side of this argument. Isn't it logical to believe that jobs created by those investments come at the expense of American workers?
Yeah, that's the argument we heard during the political campaign. But an interesting thing is the evidence shows that the more jobs these companies add overseas, the more they add in their parent company. You know, in my book, Mad About Trade, I use the example of Caterpillar, a great company mentioned just a moment ago. And it's a complete positive correlation. The more people they employ abroad, the more they employ at home, and vice versa. And the reason is, as they expand their operations abroad, there's actually more demand here at home for managers, accountants, engineers, marketing people. And let's not forget, U.S. companies, parent companies, export to their affiliates. So it's not a zero-sum game. And 90% of what they produce abroad is sold abroad. So it's not an export platform back to the United States. It's not a search for cheap labor. 3/4 of our manufacturing investment that goes abroad goes to other rich countries like Canada and Western Europe.
Which I think is an interesting point, because I think back in the days when Ross Perot used to talk about Mexico and the big sucking sound out of that country,
yes,
what he was referring to really was that we were putting the jobs there, but then bringing the goods back. And in this case, what you're saying is that, you know, the global economy now is strong enough to where they're actually consuming all the goods that we're creating outside of the country. Well, let's turn
that's right.
Let's turn the tables a little bit and talk about the investment here in the U.S. I was surprised to see this when you had written it, that you say the world's been shipping more jobs to America than the U.S. has actually been shipping overseas.
It's an interesting thing. Yes, U.S. companies do invest about $42 billion abroad in manufacturing capacity. But in a typical year, foreign manufacturers are investing $87 billion here in the United States. We're a very attractive place for investment. You know, just the other day, BMW announced they're expanding their plant in South Carolina. I was just in Mississippi, where there's a Severstal steel plant, Russian-owned, a Nissan factory, a Toyota factory. There are over 5.5 million Americans who work for foreign-owned affiliates. Their average pay is 34% higher than the American average. These are great jobs. the world is shipping more jobs here than abroad. If we start raising barriers to the transfer of investment, we're going to be the biggest losers.
Now, we didn't really hear President Obama yesterday after the midterm election speak very much about free trade or trade abroad, but one thing he did talk about was sort of mending his relationship with business. So when we talk about multinational corporations, this falls outside the purview of most Americans. It's a sort of complicated thing to understand. Do you think that the government is using these multinational corporations as sort of a convenient scapegoat? They sort of fall outside or fall under the radar for most Americans, and it's an easy way to bring in tax revenue into the country?
Sadly, yes, I think, and I have to say, especially among the Democrats and President Obama, kind of targeting multinational companies as some bad players in the global economy, when in fact they're the secret of job creation and economic growth. And I think you'll see the president moderate his rhetoric. This is a perfect opportunity to work with the Republicans in Congress to advance, say, free trade agreements with Panama and Colombia and South Korea. We need to get the U.S. corporate tax rate down. It's one of the highest in the world. It's hurting U.S. corporations. There's over $1 trillion earned by U.S. companies abroad that they can't bring home because of the high corporate tax rate. So we need to lower that. There's plenty of opportunities, and let's get this cloud of uncertainty off U.S. businesses so they can get back to expanding their market share and creating jobs.
All right, Dan, thank you so much. Daniel Griswold from the Cato Institute for joining us. We'll definitely have to have you back on to stay in touch. We'll see if Congress actually does repeal this tax exemption.